Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week, as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, January 4th, 2022. I'm your host, Will Pauly, and I'm here with my co-host, David Blake. How are you doing today, David?
Oh, good, Will. Thanks.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, we're right in the throes of the Santa rally, and we closed up last Friday with the Dow and the S&P 500, the utility index, and also the semiconductor index, all sitting at new record highs. Good way for the rally to get going. And then we started out yesterday with the Dow and the S&P 500 also making new highs, and this morning they were making new highs, especially the Dow. We're seeing some rotation into the the cyclicals, especially the energy and financial shares. So it's going to be quite a different year, it looks like, at this point. Last week it kicked off the rally basically with a report from MasterCard. It said the retail sales were up about 8.5% year over year, and that was actually one of the biggest jumps in retail sales in several years. So that was that kind of kicked off the rally a little bit. And then we also got a lot of messages about the Omicron variant and how it was not going to disrupt the economy like the original COVID-19 did. So that got investors jumping back in. Now, one of the reasons why they call the Santa Claus rallies is because of all the funds that come in that last couple of weeks of the year. In fact, last week alone, we had $24.6 billion go into equity funds and ETFs. And the week before that, we had another $12.5 billion. So just from all the 401k retirement plans, we had about $38 billion go into equities. So that's just, the tracking on there. So that's why we've had this big surge in here. Now, we did see some rotation going on. The Dow Jones was on a 6-day win streak up until Thursday, as people were buying, the energy stocks, a lot of oil-related stocks, some of the financials, which related to this the rate hikes and all. But in general, we had more of a defensive posture as the week actually moved along. We had the best performers were REITs, utilities, materials, consumer staples, industrials. I know healthcare also was strong. And what was lagging the broader market was communication services, which would be your Google and your Metaverse, whatever it is, and your technology stocks. Actually, the financials struggled a little bit last week too. I think that may have been more tax selling, and also the consumer discretionary. I know Home Depot took a big hit. Now, some of those stocks that were big winners, you have to understand that a lot of people were going to sell, mainly just because if they're paying 20% capital gains this year, they don't want to be paying 40% capital gains next year. And some of them put off until yesterday and today to sell just because they didn't want to take the big gains last year. So that's kind of a mixed bag in there. But anyway, we had Treasury yields were a little changed most of the week. Then they started to inch higher as the week went on. We had a nice little bump in rates yesterday and another one today. I think today we got up to we're somewhere over 2% again on the 30-year. So people are going to be watching that. I think it's at last I looked, it was around. It was up 2.06%. So it's quite a move up there. And also had the 10-year pushing that 1.68. So it's getting up close to that 1.7%. So you kind of got to watch some of these levels. Before, when the rate started to tick up, we said that at 0.75%, you're probably going to have a market reaction on the 10-year to that. So we'll keep an eye on that. We also had crude oil prices moving higher. That's actually at about a 30-day high, a 1-month high. Part of that is in anticipation of continued, more demand for oil. They're not kicking in the production much, but but you're going to see that increase, and they've actually been, they cut back a little bit, during the pandemic. So you're probably going to see crude oil prices move up above 85 now. I've been saying for quite a while I didn't think it would get above 80. I think that's probably going to change over the next month or two, which will help the energy stocks. We'll go over a little bit of that and what you might look at in a little bit. But anyway, so we finished the second straight week last week at the higher prices. We thought the technical condition of the market was actually kind of mixed, though, and we'll get into that right now. Despite there's several new highs in some of these indexes, we had some negative divergences that had kind of gone away a little bit, and they came roaring back last week. Part of that, some of those days, I think it was Wednesday when we made new highs, we actually had negative breadth. That means we had more declining issues than advancing issues. We also had the Dow Jones Transportation Index underperform. We had the Russell 2000 was only up about 3 points for the whole week. In general, during the Santa Claus rally, you'll see the small caps outperform the big caps, and that didn't happen. We had more buying coming into the big caps. That's why yesterday, I think briefly we saw Apple go over the $3 trillion market cap, which is kind of the big thing. Now we're seeing that move, pull back from there. You'll probably see all these big cap tech stocks come down and take a little bit of a break from here. But anyway, so the advanced decline line for the NASDAQ was actually lower last week. We had it's actually been in a decline since early November. That's just not the sign of a strong, underlying market. The NYSE advanced decline line, which I consider a little bit of a leading indicator of market direction, that has improved over the last 2 weeks, but it last made a new high November 8th. So that's something, again, that you want to watch. If this was a healthy market, we'd be seeing the AD line breaking out the new highs to match the indexes, and it's this negative divergence is a little bit troubling. And to me, it looks like we're probably going to have a bit more of a pullback here over the next week or so. We also saw a little bit more buying in some of the cruise lines and the airlines, despite all those cancellations. That's, again, is basically due to the fact that investors are looking at this Omicron is not going to be that much of a disruptor, although if you read the papers, it seems like it's disrupting quite a bit. But, the symptoms are much not as strong and more like a bad cold. And they're also saying now that if you get the Omicron, it's probably going to keep you from getting COVID-19 later on. So momentum on the overall market is basically neutral. Sentiment is neutral. Again, we're seeing a little bit of decline in the underlying breadth, which is troubling. When you start to have this much negative divergences in the different indexes, especially the secondary indexes, and especially the AD lines, it is a word that you want to be cautioned. Also, when you see the defensive sectors like the utilities and the REITs and the consumer staples and stuff outperforming, especially in a rising rate environment, that's another red flag that the market could struggle a little bit here over the next couple of weeks.
Well, the Santa Claus rally ends today, and it obviously worked out well. Can the market keep moving higher? What looks good to you right now?
Yeah, well, the market can keep moving higher, a little bit higher here, because we're seeing this big rotation, as I mentioned, out of the high growth momentum stocks, out of the high PE stocks, and people looking a little bit more defensive, and also into the cyclical trade. But that, we're seeing crude oil prices still moving higher. We're seeing the financials as rates rise. That's been that's good for the banks, especially the money center banks, and also some of the regional banks that have more lending practices, because we'll start to see the yield curve expand. And as that expands, that's good. Also, it's also good for Schwab, TD Ameritrade, Morgan Stanley now, since they bought E-Trade, and that type of thing. Actually, what I would suggest right now, let's go to the industries real quick. Okay, I want you to click on the on the 1 week percent change. Click on it twice so we get the ones that are leading. Okay, as you can see there, just over the last week, we talk about, okay, what if the Omicron's not going to be as bad, that's going to be good on the reopening stock. So you have casinos as the second strongest industry group over the last 1 week. Other recreation, lodging, airlines. You go down here, pharmaceuticals, and other, the big drugs stocks pay a good dividend. That's also a defensive group. And you go on down here, and you have semis are still doing okay. Medical devices, the internet software, okay. And then you got Eastern banks, which would include Bank of America, and some of those. Okay, now click on the 4 week percent change. And again, now you're starting to see some more of the cyclical stocks over the last month. They've been going to aluminum retailers, the drug base. Of course, a lot of that's with the Tesla and Walgreens and CVS. And you got food, water utilities, tobacco, home construction. These are stocks that are going to outperform later on in the business cycle. They have the internet financial. Again, we just talked about rising rates. Is very good for TD Ameritrade and Schwab. So you're going to see some of that. Let's go in here. In fact, let's take a look at Internet Financial. We'll click on that. Okay, we don't have very many stocks, obviously, in here because of all the mergers and stuff like that. But we have Charles Schwab here. As you can look at the chart on that thing, and it's had a nice spike up here, especially since they started talking about that we may raise rates. Kind of a little sideways in here, but you're probably going to see this. Morgan Stanley's another one that I like that, for broker dealers. Goldman Sachs is always going to be a good one. That's one you can look at. Let's go back to the 1 week percent change. Look at casinos, the second one down. Okay, now you can see that this, with the casinos, is rated, after we started talking about, this Omicron started hitting, you can see the chart up there in October, how they rolled over. So this is an opportunity that if this isn't going to be so bad, you're going to be able to get a chance to buy some of these, like, this Monarch casinos, maybe Penn Nationals, Las Vegas Sands, some of these that have corrected of probably, 20% or so. This might be a good time to nibble away at some of those stocks. Even the airlines, once they started to, with the Omicron started going on, you can go in an industry group. Again, it's one of the top 1 week and four week changers. Look at those. Just click on those different industry groups, and that's going to give you, on the list of stocks. Then you go over there and see which ones Second Opinion has rated a buy. Those are the ones that probably they're in a rising trend. Those are the ones that, especially if they've pulled back 15-20%, you can go look at the charts on them when you pull up the Second Opinion. See if they've pulled back maybe to their 50-day moving average or maybe to their 100-day moving average. And if they've held that, then you're probably going to get a nice little bounce. Now, something else that's going on in the market that I wanted to take a look at. We'll go up to the charts for a minute. A lot of you that have had some big winners in your big cap tech stocks may want to take a look at this. Let's pull up Microsoft. Now, if you're in these stocks for the next 10 years, this won't bother you that much, but you're probably feeling a lot of pain right now. But in Microsoft, let's go over here and look at what happened to the stock. You have a nice double bottom over here. Let's see, the low was 318. That was back the 1st of December. And then you had another second part of the double bottom on December 17th, where the low was 317, 318, that area. If you're in here, and even though you want to hold on to Microsoft, if it comes down and breaks those, it takes out that double bottom, that's going to be that's a pretty big sell signal. You can see a lot of traders and maybe some institutions lighting it up. At this stage, I would, if I'm on margin, I definitely would be out of closing some of these positions that I'm on margin with, and I would look at some of these bottoms that are like with Microsoft that have very distinct low here, which is just below the 200-day, 50-day moving average. You may want to consider buying some puts or doing some kind of hedging on these things. Another one you could look at, let's take a look at Apple. Okay, it came down, tested its 21-day moving average back there in mid-December. But if you look at these lows, if Apple comes back down here and takes out that 165 area, then you could be going back all the way where you see this back here around this 150 area, where you probably have a lot of support going from around July into November. That 150 area, it was pretty much sideways trading in there. You can see if you do sell it up here, you'll probably have a chance to buy some of these back at that stage. But some of the big cap stocks that you own, you may want to take a look at these, because there's some pretty well defined bottoms on these things. And as rates go up, if you're watching the TV, you watch CNBC every day, they're talking about the same thing. Growth stocks, you have to cut the PE on them and the valuations on them as rates go higher, because as rates go higher, you don't know how much it's going to slow the economy, and so it makes the forward guidance much harder to come by. So if they do start to sell these things, and they do start to break down to some of these, take out some of these double bottoms and all the big cap tech stocks, something like the top 10 tech stocks accounted for something like 25% of the gains for the whole market last year. So if they come down, you're going to see this market probably come down, and it's going to hurt. Even though if it's only like 20 stocks or 30 stocks that break support that are overweighted, you're going to feel it all the way across the board. But again, that money is going to go somewhere, and I think at this stage you start to look at some of the oil stocks, some of the financial stocks, the more defensive plays, some of the healthcare stocks I think are going to be good, and some of the consumer staples, which would be some of your food groups, that type of thing, maybe Walmart, that type of stock. And they weren't big winners last year by any means. They just kind of nudged higher throughout the year, but they were drug up by the big cap tech stocks. Those are some that you would want to look at to maybe roll that money into if you're going to lighten up on some of those positions. So, we can probably go higher, but I just think at this stage, especially with today's action, where you're starting to see the market, where you had a 2% drop in the NASDAQ earlier. It's starting to come back a little bit, because that was you're probably going to see some this rotation pick up, and with the big cap pulling back, it's going to be hard for this market to make much progress at a certain level here.
All right. Thank you, David. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it in to support@marketedge.com, or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.